Greetings everybody and welcome to this video, and we're going to talk about accounting periods. Let's hit it. All right, everybody, so welcome back to class, and in this video we're going to talk about two learning objectives. One is going to be discussing the gross income test, and two is going to be describing counting periods available to businesses. All right, so first of all, we've learned to identify business gross income. We've also learned to identify deductible expenses. Now we're going to need to match the income to a specific period. Now, if you remember back in 303, we always talked about one of the assumptions of accounting was this thing called periodicity. Periodicity, again, why do we have days? Why do we have months? Why do we have years? Well, these aren't based on accounting phenomenon. I mean, days are basically based on, rotations of the earth. Months are based on rotations of the moon around the earth, and years are based on the earth going around the sun. What's that got to do with accounting? Well, the answer is nothing. Okay, but it does create these artificial time periods so that we can measure these things up in order to make sure that things are being accounted for, and so that they can have their cutoff, so they can measure income, and then the government can come in and take some tax from that. Okay, now the way this gets done is that you first of all have to apply what's called the gross receipts test. Now there's basically three different types of methods that you could use for doing your books. You could use the accrual system, you could use the cash method, or you can use hybrid. Okay, hybrid, generally what's going to end up happening is that you're using cash method for most, but you're doing an accrual slash you're doing an accrual for like your accounts receivable and maybe your inventory. I'll be honest, I've been doing this for years. I've never worked on a company that had a hybrid system. The closest thing I think we came to was construction accounting, because it's got like this weird wonky thing that we have to do, where you've got completed contract method versus percentage of completion method type stuff. But out of those three, what's going to happen is you need to find out, before you decide whether you're going to choose one of these three or not, you got to find out if you bust this gross receipts test. Because if you bust the gross receipts test, you have to choose accrual. And there's no ifs, ands, or buts about it. Okay. So, again, $29 million for the past 3 years. I wish I ran a $29 million company, but I don't. But if your company is more than $29 million in gross receipts, that's not net income, that's not, anything else. You have $29 million in gross receipts, you are going to bust this test, and as a result of which, and it's not even just this, there's actually several other things that are going to apply to you too. And we'll talk about that. Some of the stuff happens in corporate taxation, some of it's in partnership taxation too. So we can talk about that later on. For short years, you must annualize by multiplying the 12 and dividing the produce by the number of months in the short period. So for example, say my company's only been in existence for 2 years. And we'll not say 2 full years, we'll say 2.5 years. Well, when I go back to that half year, what I'm going to have to do is take all my gross receipts. And again, if it's a half a year, what I'm going to do is I'm going to take it divided by 6 and multiply by 12 in order to figure out what the annualization is. Okay. Most businesses, when they first start out, will not have that, because usually they don't have much money going in at first. But once they get up and running, they can easily do this. Now, it depends. If you got a joint venture between, say, IBM and Starbucks, that might have gross receipts, more than $29 million day one. Okay, so don't just say, oh, first year business can't qualify. That's not true. All right. Tax shelters never qualify under the gross receipts. Yeah, tax shelters have to do the accrual method. Nothing they can do. All right. Blue Corp began business in July 1 and had gross receipts of $14 million. Can they use the cash method, yes or no? Well, July 1, that's half the year. Okay, so July, August, September, October, November, December. So that's 6 months. So like I said, take that 14 million, divide it by 6, multiply it by 12. Or you could take a shortcut and just multiply it by 2. You get 28 million. Can they use cash method this year? Yes. Okay. So the period, you're going to have 12-month periods. Now, the thing about tax accounting, you cannot have a fiscal year that ends any other date than the last day of the month. Okay. The IRS won't let you have it. So, for example, if you're, if you say that we're a calendar year taxpayer, you end on 12/31. If you say our fiscal year ends in November, you're 11/30. If your fiscal year ends January, you're January 31st. You don't get to negotiate the day. They will hit you for that. You can claim for the month. Now, there is some potential abuse here where what ends up happening is, I think we talk about it in partnership, but I'll kind of hit it here because this is actually designed to be a short video. In partnership accounting, because it's flow through entities, what ends up happening is that you file your tax returns on your personal tax returns as a partner in a firm based on when that K-1 comes to you, the year at the end of when that K-1's year end happens. So if you have a year end in January, that usually provides for what we call the greatest amount of deferral, because if you think about it, if it ends 12/31, your partnership, your income is deferred for 2.5 months, and that's when the tax is due. Or actually 3.5 months if you're an individual, because that's when your taxes due is April 15th. Okay, so 3.5 month deferral. But by advancing my year end by 1 month, now I don't take that K-1 and file it until the following year on that individual, which is going to give you an additional 11 months plus 3.5 months for a maximum deferral. That's why if you have a client who wants to file a year end of January 31st, they're going to look at this, okay, because they're going to try to figure out, is this person just trying to finagle us out of some money, or do they have a business reason? Now, you may work with an entity that has maybe you work for, maybe there's a subcontractor, prime contractor for the government, that their year end is January 31st. And you're a subcontractor and you're working directly for this prime contractor, and you want your year end to match up to their year end. That's a legitimate business reason. Okay, there's a legitimate business reason for doing that. Contrast that to say, well, my prime is a calendar year. I just want to move it to January 31st. You don't have any business reason. The IRS might deny it. Okay. Now, generally speaking, the way this goes, and I don't think we talk about this too much in class. The way you set this initially is you file your first tax return and you claim it. If you decide later on that you don't want this year end to go on where it is, you will have to file what's called a 3115, which is Form 3115. It's a very complicated form. Our firm, I won't touch one for less than $2,500, okay? Because it's very legalistic. It takes a lot of time. You have to do a lot of research. It's Chapter 2 on steroids, okay? So what ends up happening is you could file one of those, and then you ask the IRS permission. Well, if you're a calendar year taxpayer, and then you all of a sudden say, well, I want to move to January 31st, stand by for a phone call from them saying, explain why. Okay. Now, if you put a good narrative in there and there's a legitimate reason why you want to do this, they might go ahead and say yes. All right. So proprietorships, same as the year end for the proprietors. Now you might say, well, hold on a second. Aren't all individuals, aren't all individuals calendar year 12/31? Well, let's think about this. Proprietorship. Does the owner of a proprietorship necessarily have to be an individual? What if I'm a corporation and I have 100% owned single member LLC? Okay, it's technically a proprietorship that's owned by an individual. So the corporation could have a fiscal year end, and I'd have to match that up. Okay, C corps and individuals. Mark choice on the first tax return is consistent with the book with accounting period. I've been doing this years, folks. Never seen an individual do this. I've seen corporations do this. Okay, flow through entities, and I kind of give you a little bit of a taste of it where we talked about where people try to seek deferral. There is a required tax year, and so what ends up happening, there's this, and look, it's beyond the scope of this course. You don't have to worry about it. At least I don't think you do. I'll take a look at the homework and make sure that it's not in there. But generally what ends up happening is you have to calculate what causes the least amount of deferral. Okay, in terms of your year and choosing. And so basically what happens is, say, for example, you choose, you've got 3 corporate partners who are forming a partnership. One is a 4/15 year end and 2 are calendar year ends. Well, which one's going to create the least amount of deferral? Well, it's going to be the calendar year end, because those 2 that are there, of course, it also depends on the amount of ownership that they have too, right? So, for example, if the 4/15 is an 80% owner and everybody else is a 10% owner, you might get less deferral by electing 4/15. Okay. But if they're equal partners, what's going to happen is that you're going to have 2 that are calendar year end. You're going to have one that's 4/15. They're going to basically be like, look, we're going to go ahead and elect calendar year end, or force you to take calendar year end, because it's going to cause the least amount of deferral. All right, folks, so that's it. Accounting period is a pretty short topic. I will tell you, though, it can be very complicated. I know people who spend their entire lives dealing with this. I hope you guys learned a lot. If you guys have any questions, feel free to reach out to me. And if you don't have any questions, well, you can reach out to me anyways. I love to hear from my students. I want to say thank you very much for watching this video, and I look forward to seeing you guys in class.